Okay, good evening, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there, just to let me know that it is indeed working. Hope everybody's having a fantastic evening so far. Looking forward to going over this webinar with you guys today. We're going to talk about how to grow a small account and also how to pass a prop firm challenge. We do this class once a month, every last Wednesday a month at 8 p.m. Eastern. So mark that on your calendar every month. But I'm excited. This is a great class. I've had a lot of you have put some input into this class today, so I appreciate you doing that. But let's go ahead and get started. Before we jump into our discussion for today, I need to go over our disclaimer. As always, I need to remind everybody about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. Okay, guys, so what we'll do first is we'll talk a little bit about, because I know we've got a lot of people that are new to the program, so we want to talk a little bit about what a prop firm challenge is, what a prop firm is, and then we're going to spend some time talking about how to pass a prop firm challenge, some strategies that you can employ to pass, um, and I'll share some experiences. Feel free to ask questions throughout the webinar. I'll get to those questions as fast as I can and when it's a good point to get to them. So, but feel free to put them in throughout the webinar. I just may not get to it right away, but that'd be great. Also, we're going to talk about, I've got some strategies on how to grow a small account. Before prop firms were even a thing, growing a small account is pretty much how everybody gets started. And I'll give you some strategies on how to do that as well, that are really, really effective. So, but let's go ahead and jump into this. So, first of all, what are prop firms? And then what are prop firm challenges? So prop firms are they're known as proprietary trading firms. What they do is they provide capital to traders that can prove that they are successful at trading. Okay, so an example prop firm is FTMO, Top Tier Trader, Funded Next, Funded Trading Plus. These are different prop firms. And actually, let's actually remove, I just realized I need to remove that. Let's remove my Forex funds. They're no longer, or at least at the moment, are no longer a prop firm. So let's go ahead and remove that real quick. But these are prop firms that are definitely still up and running and going. So they provide capital to traders who are successful at trading. And how does that work? So basically, what they'll do is you'll apply or you will audition for a challenge. They'll give you capital, at which point you can use to start trading. And you'll basically trade in a demo account. So they'll give you a demo account to trade. They'll monitor your statistics. They'll look at, how you're doing with that demo account. And you'll just trade it. That's what you're going to do. And you'll trade your system. And over time, they typically require that you make anywhere between 10 and 15% profit in that account without breaking certain rules, which we'll talk about in just a moment. And if you can pass and make the 15% return, like I said, the 10 to 15% return, that you're now a funded trader. And then you'll make anywhere between, like the standard is 80%. I would say now 75%. So you'll make anywhere between 70 and 90% of the profits that you make, and then they'll keep the rest. So basically that way that works is every prop firm has what's called a profit split, and that can be weekly, it could be daily, it could be bi-weekly, which is pretty common, or monthly, which is also common. And at the end of a 2-week period or 4-week period, whatever profits that you end up making, they'll pay out, typically 80% goes into your pocket and the other 20% goes into theirs, which is really awesome. And this is pretty great for people who don't have a lot of capital to begin with, when you're starting out. Now, they're not for everybody. And let's talk about some of the risks of these prop firms, and we'll continue to talk about risks of prop firms in just a moment. But one of the risks with going with a prop firm is if you happen to break some of their rules, which we'll talk about some general rules in just a moment. But if you break their rules, you'll fail your challenge or the audition that you're trying out for. and you're suspended at that point. And that just means that the money that you spent to audition, which is required, there is an audition fee. It's also known as just a challenge fee. Whatever money you spent doing that, you'll end up forfeiting if you fail your challenge, which can be a scary thing. It's happened to me several times. I've passed many prop firm challenges, and with many different strategies. And I've also failed challenges with different strategies. I actually know a trader, get this, who's failed challenges 63 times. Can you imagine spending audition fees on 63 different challenges and failing all of those? That's just crazy. He's passed though. And what happened was he tried out these different EAs, and a lot of these EAs didn't end up working. Um, and then he just had a couple of EAs that worked, and the couple of EAs that did work ended up paying out for the prop firm fees or challenges that he ended up losing. So worked out for him in the end, even though he lost 63 different times. So kind of crazy, right? Um, anyway, I guess that's the definition of not quitting, just staying with it. But he would be interesting to have on in fact, maybe I'll see if I can get this guy on our call one of these times. We'll do a dual webinar where we can share the screen and he can talk too. That'd be kind of cool. Anyway, so prop firms. Typically, what do prop firm challenges cost? So prop firm challenges, they provide capital that's usually anywhere between $5,000 all the way up to, well, millions actually. But the standard I would say is between like 50 and 200,000. Most people apply anywhere between a 50 and a $200,000 account. Okay. And so, hey guys, one second. I got to close my blinds. It's getting the sun is just right now to get me. So, got to fix that. Okay. So, the average prop firm is anywhere between 50 and $200,000. That's what people apply for. Um, so and what do they cost typically? Well, it's usually a half of a percent of what you're applying for. So for example, if you want to apply for $100,000 account, 1% of 100 grand is $1,000. So a half of $1,000 would be a half of a percent. So it'd be $500. That's the typical cost for a 100K challenge. Some places will have offers and promotions where you can save a little bit of money. There's promo codes you can use and things like that to, help you pay a little bit less. Which is another side note. I recommend never paying full price for a prop firm challenge, because if you're ever going to apply for a prop firm challenge, there's almost always a discount somewhere that you can find. In fact, I know people who have just emailed prop firms and have said, "Hey, look, I'm going to buy your challenge if you can give me, 15% off or 20% off or something." A lot of the times they'll go for it, so you don't have to necessarily pay full price, which is kind of cool. Okay, what else did I want to cover here? So that's just the general concept of a prop firm challenge. If you wanted to apply for a 200K challenge, that's going to cost you about $1,000 typically. FTMO is a little bit more expensive. I think it's like $1,060 last I checked. But yeah, that's what a prop firm is in the first place. So what are the general rules? So most prop firms do what's called an evaluation. And an evaluation is often accompanied with a one-phase and a two-phase challenge. So there's basically two obstacles you have to jump through in order to get funded. So phase one is where you have to trade the account like normal, and you'll have to make a 10% return. A lot of places now do it at 8%, so you just have to make an 8% return without breaking any of their rules. And as soon as you pass phase one and make that 8% return, they then give you a new account where you then have to make 5% in phase two. That's pretty common. After you've made the 5% in phase two, you're now a funded trader. They'll give you new credentials to a funded account, at which point you can start trading. And like I said, that's the money that you'll be making going forward, is in that account. So that's what you're trying to go for. There's other companies that out there, a lot of prop firms that have one phase challenges or instant funding challenges. I'm not a big fan of those types of challenges because a lot of the times prop firms will try to entice traders into less favorable challenges. And what I mean by that is if you jump into a one-phase challenge where the rules are kind of strict. So for example, I've seen one-phase challenges where they say, hey, you just have to make 10% and you don't have to make 5% in phase two. So as soon as you make 10%, you're done. But the problem is that the rules are a lot tighter. So instead of having a 10% max drawdown, which is standard, the max drawdown is often like 6% or 8% or something like that. The daily drawdown often is tightened up as well. Instead of being 5%, it's more like 4 or 3% even. So that's the benefit, or I guess not the benefit, the con of going with a one phase challenge is yes, you could technically pass a little bit faster because you have less money to make, but it's at the peril and the cost of some of the other rules not being in your favor. So I'm all about rules that are in favor of the trader, right? And so that's why I'm not a big fan of one phase challenges. Typically, if somebody comes to me with a one phase challenge, I'm always just going to ask the question, what's the catch? Why are they offering a one phase challenge? It's probably because the one phase challenges um, are just a marketing ploy, in my opinion. They're often just used to help entice traders. Another thing we'll talk about in just a minute, and remind me if I forget, but we need to talk about scaling plans. That's another thing. There's pros and cons to scaling plans, and a lot of people like to jump into scaling plans, but there's some definite cons we need to talk about there too. Okay, so another thing is called instant funding. So instead of a one phase and two phase evaluation, again, one phase and two phase is known as evaluation. Okay, but then you have this instant funding concept. Instant funding is basically where a prop firm will give you money right now to trade. It's real live money to trade, which is awesome. Who doesn't want that? That's a great. We'd love that. But what's the downside to instant funding? Well, there's a big downside. The biggest downside is the cost to entry. So the audition fee to trade with an instant funding challenge is usually going to be something like a lot. It's going to be a lot more money. So I've seen a lot of places where the challenge fee is going to be um, it's going to be whatever your stop loss is. So if they give you a 5% max drawdown on instant funding, then whatever 5% is going to be the cost to get funded. So for example, if you wanted to get a $100,000 account with instant funding, typically the challenge fee is going to be around $5,000 because that's 5% of your drawdown, which is so you're basically funding your entire drawdown to have $100,000 of trading capital. So they're really risky. So if you end up losing $5,000 on that 100K account, you would lose all $5,000 that you spent. A lot of prop firms have actually kind of gone away from that because that's a red flag for litigators and things like that. So if people go out there and start spending $5,000 on prop firm challenges and they fail those challenges, obviously you're going to have a lot of really unhappy customers, which happens a lot with, so they're planning on just a bunch of people failing and collecting that money. So when you see those types of challenges, that's not your friend. You don't want to associate yourself with those types of challenges. Okay, so instant funding challenges, I'm not a big fan of, especially instant funding challenges. And then you have one phase challenges. I'm not a big fan of those either, um, because they're designed to kind of hurt the trader. But I do like the evaluation challenge. But another thing I want to make sure I'm very clear on as I discuss prop firm challenges today, just a little disclaimer here, is that they're not for everybody and they're definitely not for every strategy. Certain strategies are well equipped for certain prop firm challenges and other strategies are not. And every prop firm has their own set of rules. Every prop firm has their way of doing things, right? And so maybe the strategy you have is good for one prop firm, but it's not really good for another prop firm. right? So these are things pros and cons that you have to weigh with each one. Okay, let's continue on here. Most prop firms require that you have a minimum of 5 trading days. They do this because some people try to pass prop firm challenges in like 1 or 2 trades, which I've actually done before. I've taken trades in the past where I've passed challenges in just a single trade. It's really risky when you do that, and it's pretty easy to fail if you do that. But if you pass, it's pretty awesome because you're like, oh, I passed my challenge and it only took me just 1 or 2 trades. But this is just to prevent people from doing that. So they require you to trade a minimum of 5 days. There's other rules like I said, in phase one, you have to make 10% return. This is no longer the case, actually. Let me actually change this real quick. You actually don't have to make 10% in 30 days. Usually now it's unlimited time. So um, make 10% in phase one. That's all you got to say right there. Perfect. Make 5% return in phase two. Yep. So this is the general rule right here, is that you just have to make 5% in phase two and 10% in phase one. And other places actually do it at 8%. A lot of places now do it at 8%. How did this actually come out? A lot of you guys probably have heard of FTMO. FTMO is kind of the standard in the industry, and they're the ones who kind of made these rules, and everyone kind of copycatted them going forward. And some places do it a little bit differently, but these are the general rules that you want to look for. If you ever want to discuss a prop firm with me, I'd be more than happy to go over their rules and kind of go over the pros and cons with you, just because I've seen a lot of different prop firms and I kind of know what to look for as far as like what would be good for certain strategies and which ones are not as good. But this is generally what you're after. Okay, so how do you pass a prop firm challenge? Okay, so a couple of things. The first thing is really, really important. When you're trying to pass a prop firm challenge, it's imperative that you know the rules of said prop firm. I've seen a lot of people, including myself, fail challenges in the past because we thought we could get away with a certain thing, but it happened to be a rule with a specific prop firm. And some places have really stingy rules, and I don't like prop firms with a lot of stingy rules like that. So if they have a lot of fine print, I get kind of nervous, and I usually want to move on to the next one if they have a lot of side rules. But it's really important to get acquainted with all of their rules, especially the main ones. But some prop firms we already went through some of the main rules, like, the drawdown stuff is the main stuff. Like you can't lose more than 5% in a day, typically. Can't lose more than 10% total or 12% total. Okay. But there's some other rules, like some places allow copy trading, other places don't allow copy trading, other places allow you to trade through news, and other places not. And then there's some with weekend holding. You can hold trades over the weekend, and some places you can't. These are things that you have to kind of look into before you jump into it. A lot of people try to pass prop firm challenges with EAs, which are known as Forex robots, or an algorithm. They try to pass with an algorithm, and some places allow that and other places don't. It's really important to be aware of what they allow and what they don't allow. So this is, you could have a great strategy that works really well for you, but if it's not a strategy that works well with that prop firm, that could get you in a lot of trouble. So try to know, not just try, you must know the rules of your prop firm before you embark into that. Most places will have a single page or a couple of pages on their site allocated to just knowing what the rules of the prop firm are. Okay. Now, the next part really depends on you, right? So you have to have a game plan going into a prop firm challenge. Okay. In fact, I would argue that nobody passes a prop firm challenge without having a game plan. And actually, let me share with you guys real quickly. The first ever prop firm challenge I embarked on, I failed. It was a 200K challenge with FTMO. Nothing wrong with FTMO. It was my own doing that did this. So I actually had a good game plan. I wrote down everything that I was going to do, and how I was going to pass. And I had actually passed with their free trial multiple times before I even jumped into the challenge. Right. So I was actually doing pretty good. And I felt comfortable enough to jump into a challenge. So what happened? So when I jumped in the challenge, I had a game plan. I had written down all my rules. I had it posted on the wall over here, and I had it digitally on my computer. And I started trading and I started doing everything I was supposed to be doing. And then the first week, just, I guess not beginner's luck. It was just, happens to everybody, right? Your first week, you just start not trading well, after you go live with a real, account with a prop firm, a challenge. And I took some losses. Now they were all calculated normal losses. And then the second week was a little bit better, but I still felt like I needed to catch up. And by the way, back then they weren't unlimited time. Um, I had 30 days to pass my phase one with FTMO, and if I didn't pass phase one, I would fail my challenge. And that was before, again, that's before they made this update where you have unlimited time to pass now, right? So yeah, I got myself into trouble because, the clock's ticking. You have, 2.5 weeks left, or now you have just 2 weeks left to pass and you're still behind, right? So by week three, over the weekend, I had thrown out my old strategy and I had gone towards something totally different. And I had a new game plan with a new risk management model of how I was going to pass the challenge. And I actually did okay, but I still found myself behind by week four. And by week four, I had to take some extortionate risks. So by the last couple of days before my challenge had expired, I found myself trying to make $10,000, $15,000 on a single trade, on a 200K account, which can be done. But if the trade fails, you're kind of SOL and you have to make all that back up again. So I basically just tried to find best trade I could. Of course, it lost, and then the next trade, um, I had like one last opportunity, and it was actually kind of sad because that trade ended up working out, but it wasn't in time, right? So I learned a couple of lessons from that first prop firm challenge that I ever went through. And one of the lessons actually is don't ever go with a prop firm that puts time limits on you. You don't want to have time limits. Trading shouldn't be an element of time, in my opinion. It should be an element of taking the best trades possible, taking the most quality trades possible. Should be an element of going through the processes and practices at a normal pace and at your speed, the way you've prescribed it for yourself, because that's the way you trade. So, yeah, don't ever go with a prop firm. I mean, I did end up going back with them again, and this is while they were still timing people, and I did get funded with them. But now that I look back on it, I would never, and this is something I would tell you guys to do as well. Don't ever sign up with a prop firm that has time limits. It's not very common anymore, but even just a year ago, it was pretty common to have time limits. Um, but yeah, if you ever see a time limit challenge, I would just move on to the next one. I wouldn't give them time. The other lesson that I learned from that first time, was to stick with my strategy, because the original game plan was a good game plan. It just had normal losses with that strategy. So there's nothing wrong with sticking to your system if the losses are normal, right? I think sometimes, especially as a new trader, it's really common to experience losses and consecutive losses that can last for days and sometimes weeks even. And, with a little profit sprinkled in there, but you're still losing money. I think a lot of times traders look at that as a catastrophic failure, and it's not. I'm here to tell you it's not. If you've back tested and you've forward tested and you've traded it over and over and over again, and you've gone through those normal losing periods, it's okay. Right? It's okay as long as you're staying true to your system and your system has that edge and a track record, you should feel confident to continue with that system. What you don't want to do is become what's called a strategy hopper. A strategy hopper is somebody who moves from one strategy to the next strategy to the next strategy and so on, right? Um, I think it's great to improve systems that you already have, but if you find yourself constantly on YouTube trying to find something different to trade or listening to the next talking head, you're gonna go through just like a doom cycle, right? And you'll find yourself very frustrated doing that. I've done that many, many times, and I've had to kind of learn from experience that that was happening. And the way I learned to trade was fine. Like it was a great way to trade. I've got several ways to do it. There's many, many different ways to make money. It's just a matter of sticking to what you know, and what works for you. And normal losses are a thing. Um, you can't like when you're investing in the stock market, like if you have a 401k or an IRA or a pension fund, those things fluctuate all the time. And I don't know if you've looked at it recently, but we've had a lot of stocks that have been down over the last couple of weeks, months even. And so those things go through normal fluctuations. Sometimes there's years even where I mean, obviously trading, we need to be making money more often than that. Like you really don't want to have a losing year trading, um, which I've had, but you don't want to do that very often, like ever. And there's a point where you can avoid that. I haven't been able to avoid losing weeks. I still have losing weeks. I still have losing months trading. But I've never had a losing year. At least in the last 3 or 4 or 5 years, I haven't had a losing year trading. Um, but the stock market, like last year, the S&P 500 lost, I think it was like 17 to, if you count, I guess if you count dividends, it was a 17% loss in the S&P 500 last year. Um, But I mean, does that mean you go out and withdraw your entire IRA or your 401k because it had a 17% loss? No, in fact, you keep investing into it. You keep adding to it because you have trust in it. You have a belief in it that it will continue to do well over time. If you lost that belief, then of course you would withdraw it. But if that belief is still there, you'd keep going, right? Okay, so some of the things that you should have in your trading plan. So everybody needs to create a trading plan, and you can have trading plans for different things. I have trading plans for the COT report. I have trading plans for the sentiment strategy, trading plans for my price action strategy. I don't trade this strategy anymore, but I have a trading plan for the banker's close trade. We used to trade that a lot about a year ago. You can actually go back like a year in the calendar, and we used to trade that strategy a lot in the mornings, but we don't trade the banker's close as much anymore. And there's some reasons why. If you want to talk about it, we can. But I feel like what we're doing is a superior way to trade, so we've just kind of stuck with that. The couple of things that we do now. But yeah, trading plans are important. And actually, one of the things we're going to talk about in a little bit, not in this webinar, but in the COT report webinar, I've been working on the COT report. I've been doing some back testing on some things that I think you guys are going to really like. And that will adjust slightly. There's a few things that will adjust very slightly with the COT report. And there's probably more changes coming in the future, but very few changes. And it's not like, and that's what's good about having a trading plan, because if you fundamentally change your plan every week or every 2 weeks, how's that going to help, right? So it's about modifying and adjusting as needed as your back testing and forward testing proves that there's a better way to trade, right? So you make those adjustments going forward. And it's not something that you fundamentally change every single week. You don't want to be like I call it a strategy hopper. So in a trading plan, you should know what you're going to trade. Are you trading Forex? Are you trading stocks, options? What are you trading, right? So you need to know what, and specifically if you're going to trade Forex, are you going to trade all 28 currency pairs because that's what your strategy requires, or are you going to focus on one, two, or three total pairs? Um, so pick what you're going to trade. Also pick the time frames that you plan to trade on. It's important to know how things work. So for example, if you're a trader that trades on a 1 minute or a 5 minute chart, you're likely a scalper. And people who trade on a 1 minute or a 5 minute chart need to be aware of certain things. What are the things that a scalper would need to be aware of more so than a swing trader? I think scalpers need to be aware of news like crazy. They have to know what news events are coming out because those could drastically affect how they perform. They also need to be aware of session opens and closings. So you need to know when the London market opens and closes, the New York and Sydney and Tokyo markets open and close, right? Really important stuff. When you're a swing trader, you're probably going to trade on the 15 hourly or 4 hour time frame. That's going to be where you're at. Probably most likely the hourly time frame is where you're going to spend most of your time. And that kind of trade, that's a lot. You guys know that's kind of my style is an hourly. That's kind of like my time frame. I do go down to the 15, as you guys know, but I don't go lower than 15. Sometimes I'll go up to, you guys have seen me go up to a 4 hour before, especially if I'm looking for long-term order blocks. 4 hours is a great place to find those, and hourly as well. But that's kind of where I'll tread my water is between there. And I know that, and I do, and that what's cool is for all the strategies I trade, I'm doing the same thing. Like if it's COT report or if it, and actually COT report really doesn't matter too much what time frame you're on because it's a basket of trades, as you guys know. But the when I'm trading sentiment or if I'm trading price action, those kinds of strategies, I'm usually on that 1 hour chart because I'm more of a swing trader that way, or an intraday, I guess you'd call it, because I'm looking for trades that'll last anywhere between 24 hours and 72 hours is kind of my hold time, right? Right. Gotta know those things. Additionally, and I think I mentioned this in one of these bullet points, but kind of along that same timeline. Oh yeah, here it is. So you need to know the max amount of trades you'll take in a day or a week. Why is this important? I thought a lot about this bullet point right here. So there, revenge trading is a real thing. Okay, revenge trading is where somebody will jump into the market, and if they're having a losing period, they'll try to overtrade. They'll try to take more trades to kind of fix their losses, right? Obviously, that's great if you're doing well, but if you're in a losing streak or the strategy you're trading is not working with the type of environment that the market's in, then you're just asking for more losses, right? So what I think is a good deal is to have kind of a set amount of trades that you would take in a day or in a week. So often when I'm trading with you guys, I'm trying to find one setup a day, maybe two, but I don't usually go over two setups a day because if the environment that I'm trading in changes drastically and I have 10 trades on or five trades on, and things go south, then you could lose a lot, right? I mean, you could make a lot if everything goes in the right direction, but you don't want to bet on that, right? So it's good to have a consistent flow of trade opportunities that match your time frame and that match your style. Another thing that, and this is the point I wanted to touch on earlier, is I think it's really good to have a set time that you trade. Right. So I trade with you guys in the mornings. That's kind of my routine. I'll often check the markets before I get on with you guys. One of the first things I do in the morning after I kind of get ready is I like to check to see how my COT trades are doing for the week. And I like to see how the sentiment trades are going. And if I have any price action trades going, I like to check on those. I have stocks that I trade as well, and I like to check on those. Um, I just kind of monitor them, right? But I don't really jump into the charts until after I've done my morning routine. It's just kind of my style, and that's what I do. When I first started trading, just a little side note on this topic. I remember when I first got my first ever trading account set up and I got my platform downloaded on my computer. I was so excited, guys. You guys know I love trading, right? So I was so excited because I was 18 and I got everything downloaded and I had a little laptop. I probably and I was exclusively on and the platform I had 30-minute candles or 30-second candles, sorry. So it wasn't just a 1 minute chart, it was a 30-second chart. So that thing was moving all the time. And I was just captivated by the markets and their movements and what things were doing. And I remember one morning, I woke up the next morning after I got everything set up. I sat in front of the computer and I probably sat there all day. I looked at my watch and it was 4 or 5 o'clock in the afternoon, and I had only gotten up a few times just to eat or get a drink or whatever. So, it wasn't it was a hugely it was a failure of a day, right? It wasn't one of those days where you're like, oh yeah, today I worked out, I went on a walk, and I went to the store and I took care of business and answered my emails. It wasn't like that, right? And so your day is kind of shot, and you kind of hate trading if that's your routine. So you want trading to become a routine where it's incorporated into the things that you already do, right? And the reason why that's important is because you will naturally trade better if it becomes part of your routine. If you're used to how the market reacts during a certain time of the day, then you're more equipped and more ready for how the market's going to move the next day and the day after and the day after, because you've seen certain market conditions over and over and over again, and they're typically about the same, right? But what ends up happening to new traders, and this happened to me a lot, is the afternoon doldrums. So you have the markets where they don't do much in the afternoons, and I would just trade in the afternoons when the spreads were terrible, and I'd end up opening bigger contract sizes on a 1 minute or a 30-second time frame, and it just got bad, right? So you don't want to be that way. Anyway, I got to move on. The other thing that you guys got to do is you got to have an RR ratio that you're going to stick to. Most of my trades, I stick to a 1 to 3 and a 1 to 5 if I can get those. On occasion, I'll take a 1 to 2, but I don't like to go below those. You need to know if you're going to trade news. Your edge. What is your edge? Just real quickly on this subject right here. Your edge is basically what makes your strategy work, right? Um, and it can be very simple. So an edge is, oh, I trade the COT report because I'm trying to trade like the banks. And so, what's the steps to my edge? Oh, my edge is I go and find out what the banks are buying and selling, and I'm going to take the top 6 currency pairs by pinning the most strong currencies against the weakest currencies every week, right? That's an edge, okay? And then on top of that edge, we have things like risk management, whether you're going to use a trailing stop or how big your lot size is going to be, and lot size calculator, uh, where your just hard stop's going to be. All that kind of stuff is important. But your edge is the reason why your strategy works. When we trade sentiment, obviously, when we're trading sentiment, we're looking to trade against retail traders most of the time. And that's actually just the edge. The edge is simply, find a currency pair that is highly biased by retail traders. And then from there, it's just a matter of going through the steps of finding a structure break and also trying to find out if there's an order block nearby that justifies their move. If it doesn't, then you want to continue the direction against the retail traders. That's the edge that we have there, right? That's what an edge is. So okay, let's move on. So guys, I got to move on quickly. We'll probably just spend 10 minutes on this and we'll start wrapping up, but I want to kind of switch from prop firms for just a second. Um, when you're, and actually, let me wrap up my thoughts on prop firms. When you're trading with prop firms, it's really important that you know what your risk management is per trade, because if you have consecutive losses, which we've had recently on like the COT report, and you could be trading another strategy, totally different strategy, and that strategy could have some losses. It's important to know how many trades you're going to take a week versus how big your lot size is going to be on each one and what percent risk that's going to be, because you want to make sure that you can dial in how much risk it is going to be total. And then if you start to lose money, then you have time to respond and kind of protect your account before you get yourself into a lot of trouble with that prop firm account. So I've had prop firm accounts like in July. I had a prop firm challenge that I started in July, unfortunately, and that account got down to, like with the COT report, started it in July and immediately I started losing money and I took that account down to like 190. It was a 200K account, took it down to 190. And then in August, I got it over 200,000. And then in September, it's been bad. I'm back down to 191. That's where I'm at in that prop firm challenge. So it's been pretty frustrating, but it's all within the realm of the strategy. And I still have, so I've lost 4.5% on that account, but it's all within the strategy rules. And I'm, as long as I continue to follow my system, I'll be fine. So anyway, that's just my last little bit of advice there on prop firms, is that you really, really have to know how to use a lot size calculator and know what you're getting into that way before you jump in. One last recommendation about prop firms: before you jump into any prop firm challenge ever, okay, I would recommend that you pass a free trial challenge with a company like the Funded Trader or FTMO. They allow free trials that have demo accounts with the dashboard and everything as if it's a challenge. Pass that challenge first. If you can pass and you're comfortable with it, I usually want people to do it 2 times. If you can do that 1 or 2 times in a row, I would say, if you're up to it, then go ahead and do a prop firm challenge. But again, even if you can do that, it's still not for everybody. It's just up to you. So that brings us to the next thing, which is how to grow a small account. So growing a small account is a honestly is a great practice, because this is how everybody had to do it when they got started. Or some people would actually go out and just like borrow a bunch of money and do it that way. I don't recommend that. Again, just for the record, I don't recommend that you go out and borrow money. I know plenty of people who have done that. I've actually done that in the past with different investments where I've borrowed the money I needed and done it. But it, again, anytime I did that, it was a personal risk I took, and it was money I was willing to risk, and it was money I was willing to lose and make the payments on if I were to have lost on those investments. Um, y'all, every single one of you has to determine what you're willing and not willing to do, right? So let's kind of talk about the strategies of growing a small account, and also why this is important. If you can grow a small account, one of the cool things about growing a small account, even if it is like you say there, $100 or $1,000 or $500, is this is your own money, and you're dealing with raw emotions with a very small amount of money. And so if you end up losing money there, you feel real pain. Whereas if it's a demo account, you don't feel that pain as much. Even if that demo account is a big account and you lose, $10,000 on a demo account, it's still demo. You're not going to feel it, right? But if you lose even just $100 sometimes on your first ever funded account that's funded by you by your own merit, that really hurts, right? And so you get these raw emotions faster when you're growing small versus somebody who just jumps in with, a big account to begin with. So it's kind of nice to actually feel those emotions right away. It'll help you become a better trader. Now, does that mean everybody should just go out and put $1,000 in an account because of that? No, there's other ways to feel pain. Trust me, right? And it should all be calculated. And I'm not the one who can tell you if you should do this. Maybe this isn't for you either, but this is how people did it before prop firms, and this is how people still do it. I know plenty of very successful traders who have never done a prop firm challenge in their entire life, and they've made millions by growing their own account, just with the blood, sweat, and tears of their job and saving money on the side. So how do you do that? Because things are expensive right now, right? There's inflation and cost of living's gone up, and And it's really, really tough. So you sometimes have to make some serious sacrifices to make what you want happen. I remember, you know, um, in the past when my wife and I needed to buy a car in college or something, or we needed to pay for a medical bill or something like that, we've had to cut back on things. In fact, I won't go into the details on this. It's a little personal, but yeah, we've had some medical bills on some things recently, and it's cost us tens of thousands of dollars recently on some things. And we've even cut back on stuff. Just because, yeah, that kind of stuff happens in its life, and we all have to deal with that kind of stuff, right? And sometimes I think people frown on like doing the good old way. It's like hard, but sometimes that's the way to do things, and that's the way to get to your goals. And I feel like people who go through this way of getting whatever they want in life, whether it is you want to buy another house or you want to buy another car or whatever it is that you want to pay for, going through the blood, sweat, and tears and creating your own sacrifice, force feeding your own sacrifice, sometimes is the most rewarding thing that you could possibly do, even more so than a prop firm challenge, because you're pushing yourself and doing something that you wouldn't normally do. So these are some tips. I won't read them all, but these are some tips you guys can go through. You've probably read them already as I was talking, but maybe this will give you some ideas. If you create a budget, automate savings, or do any one of these bullet points here, these are ideas that you can go through to save some money to help you put money away that, maybe your budget's tight, but if you can think of 4 or 5 things on that list there, or all of the things on that list there, that's a great way to save money. Another thing too is I feel like here in the United States, we're so used to having cars. It's not that common outside the United States for everybody to have a car. It's kind of a luxury. I spent 2 years living in Guatemala, and when I was and I spent 6 months in Mexico for a thing that I did over there. And it was if you had a 25 or 30-year-old vehicle in Guatemala or Mexico, you were sitting really hot. Like people looked up to you, and they called on you for favors all the time for having a Camry or a Corolla that's 25 years old. It's just like an American thing. I feel like for us to have the nice new Wagoneer that's 110. Have you guys seen that? It's $110,000. Right? Or whatever, it's a little bit more of an American thing, I feel like, for us to have that. And we do live in a blessed nation where we have a little bit more, and so naturally I think, if you have the means, you'll go out and buy those nicer vehicles, but it's not necessary. If you feel it is, then great. It's your money, but it really isn't necessary to do all those things, right? And so I used public transportation when I was going to school, and I was surprised. I was like, wow, these buses come by all the time. That's amazing. There's ways you can save money. I feel like this is just my own thoughts here. When you do frugal things, I feel like, and this is just me, that I feel more actualized and I feel better about myself. I feel better about my place in society if I'm not just thinking about how can I just get more. Obviously we're here to get more. We want to make money, but I think if you can make a lot of money, but still live without spending like a crazy crazy drunken seller, right? There's a huge inner peace that comes with that. There really is, by just having what you need, right? This is just a personal, it's kind of dear to me to kind of think this way because I lived this way for a long time and I saw people living this way for a long time. Like I said, I spent 2 years in the highlands of Guatemala, and I saw people who I went to homes where people had they didn't have floors. They compacted dirt floors, and that's how they lived. And they gave freely. They'd feed you food, and they'd have nothing, and they'd still feed you, which was really cool. And they were the happiest people you'd ever meet, right? They really were. So yeah, these are really good things you can do. And if you can do 4 or 5 of these things and save up, I can tell you right now, for most of you in your budgets, you could probably find a way. I think each one of you could find a way to save $300 to $500 a month by doing all or some of those bullet points right there. I can almost tell you right now there's a way to do that. You just have to get crafty, right? The other way is to, you could find a way to make more at your work, make more money, get another raise or move jobs or whatever it is that you could do. Sometimes just making more money is another way to solve that issue. But I've often found, and this is just from personal experience, that um, just making more money often doesn't solve the issue if you haven't solved this issue right here. So if you haven't really learned to live on a budget, or if you haven't really learned how to live with less, um, sometimes making more money doesn't really solve the problem. I've seen that happen a lot. I've seen people who make 100 grand a year get a raise that's now 150, and they're still in the same issue. I mean, you guys have probably seen that with a lot of the people you know. Maybe you've experienced it personally. The key is get that $150,000. If you're making 100 grand and then you make 150, but then make your budget as if you're spending 60, right? All of a sudden you've got a huge surplus, right? That's the key, is being able to do something like that, so that you can do this next thing right here, dollar cost averaging. So dollar cost averaging is where you put money into something over time. So you're putting $100 a week, $50 a week, $20 a week into something that you believe in. So this often happens automatically for you when you invest into your 401k, your IRA, your pension. A lot of this happens you don't see it really on your paycheck, like when you're getting paid from your job. It just gets automatically pushed in those things. Some people have money in distributions that go into like an HSA account or a health savings, or you've got savings for your kids, college fund or whatever. These things just happen behind the scenes and they just go into an investment vehicle that can grow over time. That's the same thing that you could apply when growing a trading account. So what I've done in the past is, if I'll open a trading account. A couple of years ago I did this. Or not a couple of years, several years ago I did this. I had $1,000. That's all I had, and I put it into a trading account, and I just put in $50 a week every week into that, and then I'd grow it from there, and I'd add another $50, grow it a little more, and take a few trades, grow it a little bit more, put another $50 in, and pretty soon it starts to compound from there, compounds outwards, right? And it can happen pretty quickly. Even just $100 a week gives you $5,200 a year in additions, because there's 52 weeks in a year, and then you have your compounding on that. So if you can get, like with the COT report, I know it's been down recently, but it is still averaging a 50% return a year. I know that's crazy when you look at September. I know, but looking at the data, and I'm going to share the stuff with you guys in a little bit, but it's making 50% a year. Um, so, and it's done so over the last 3 years. At least it's averaged at the worst year I've ever had with the COT report, it made a 36% return. Um, that was its worst year, which was 3 years ago. So anyway, that's still a pretty good return overall. A lot of back and forth, a lot of ups and a lot of downs, but overall that's what it's done. So if you're dollar cost averaging plus getting the returns of an investment, you can see how that can grow over time, right? So the whole point of saving money and reducing your costs and or getting a raise at your job is so that you'll have more money to dollar cost average your trading account, right? Another thing too, guys, this is another reason why it's so important to learn risk management, because if you don't learn how to use a lot size calculator, you could lose all of your money all at once. All this hard work you put in to make this stuff happen for yourself, if you don't manage your risk and use a lot size calculator, you could lose all of this dollar cost averaging. Everything that you sacrifice could go all the way all at once if you're not doing that. So anyway, just something I wanted you guys to think about is, you're not going to trade successfully long term if you're not going to be committed to using a lot size calculator. I do that, by the way, on every strategy when it comes to price action, sentiment, COT reports, all the same. All right, let's look at some of these other comments here. Lee says pay off loans early is another good purpose. Yes. Yeah, if you can pay off loans. I actually did a couple of years ago, well not, I guess it's been 4 years now. Me and my wife, we bought some Bitcoin on a loan. I know you can judge me all you want, but it worked out really, really well. It was a great investment for us. We planned it out and yeah, we were paying interest on that, but anyway, I think I've told that story before. That's actually how we put a down payment on our house was through Bitcoin, and it was because we took out a loan on it. Um, I follow Bitcoin a lot, and I follow the cycles of Bitcoin. And anyway, that's another topic for another time if you guys are interested. I like what original Wagoneers way better. I like that. That's awesome. I love that. Nothing wrong with having nice things, guys. I'm not trying to say you can't. I'm just what I'm trying to say is do things within your means, right? And work on the playing field that you're at right now. If your playing field is at the level where you can buy those things, then fantastic. Buy them in cash. Don't put a loan on it. Buy it in cash, right? If your playing field is still driving a 25-year-old Corolla, fantastic. I love it. I love it. I'm not going to judge you for it ever. In fact, fantastic if you're doing it. If you can afford $20,000 vehicle and you're still driving a Camry, I love it. Fantastic. Keep doing it. I'm proud of you. So, all right, guys. So I'm going to go ahead and wrap up, and in a few minutes we'll meet up for the COT report. And I've got some good stuff that I think you guys will be excited for. So, thanks for coming, guys, and we'll see you in just a few minutes.